so much for joining me. I'm so delighted to have you on the show and so pleased that you agreed to the interview. What prompted it really was that I was writing my monthly edition for subscribers the other week and digging around, what can I write about this time? And a colleague of mine came across an article that you had written regarding, where the future of where the property prices are going to go. And you were kind of insinuating that we may have hit the bottom of the cycle, which is very similar to the song sheet that I've been singing from sort of over the latter part of last year, as we saw indicators in the housing industry start to improve. But I guess where I'll start is last year you took part in the great housing debate with Chris Joy. And I read the synopsis of it. I sort of didn't read the entire all of them.
Probably enough, yes.
Well, it was probably enough, but it was an entertaining synopsis regardless, and kind of encapsulated that, because what Chris Joy was saying was that property prices, he had one of the bearish forecasts that came out.
Extremely bearish. He was very gloomy, yes.
For peak to trough falls in the prices, like 15 to 20%. And of course, he gets a wide platform and came out with this crash scenario. And then you rocked along and said, well, actually, this is a very one-eyed view looking at the property market through just the interest rate lens alone. And I reckon they're going to fall around 7% peak to trough. And we got to around that number in January of this year. And at the time, Chris Joy, I'll let you talk in a second, he tweeted out, who won the debate, and of course all the Twitter bears.
Yes, don't go there. Yes.
but I think I would have sided with you at the time. So do you just want to kind of give what were you seeing last year that kind of indicated to you that prices weren't going to drop as far as some of the bears were?
Yeah. Just going back on a couple of those issues, because I think it is important. The housing cycle in Australia has been for many, many decades, will be for many, many more decades. And I think the point that I try to look at too, of course, is the nationwide house prices. That's obviously the big picture, if you like, but acknowledging that there are very, very different markets, from Perth to Sydney to regional areas to Hobart to Brisbane, for example. So my view is sort of based more on the broader picture and what had happened in the past. When you take a step back on what drives house prices, which is obviously the most fundamental issue when you're trying to forecast them, the interest rate cycle is just that. It's a cycle. Interest rates tend to go up, they tend to go down. And of course, when they're going up, it acts as a negative for house prices. And when they're going down, it tends to act as a positive for house prices. People can borrow more and the like. However, it's not the be all and end all. And some of the research that I'd done prior to even the start of this last rate hiking cycle in May 2022 was looking at different interest rate cycles since the early 1990s and what had happened to house prices. And in most of those instances, interest rate hikes actually coincided with house prices going up. I thought, what on earth is going on here? Mm-hmm. So I dug deeper into the data. Mm. That showed me that a strong labour market was very important for house prices, because of course, even when interest rates are low, if you don't have a job, it's very hard to get a mortgage and buy a house. If interest rates are high and you've got a job and unemployment's low and you're getting okay wage increases, you've got to have a better ability to get a mortgage, buy a house. So that was the first thing. So the labour market said to me that that's an important part of what drives house prices. And the other one, which is arguably even more fundamental, and it shows up if we dig into capital city house prices with the new supply of dwellings relative to demand, which is inevitably population growth, and demand and supply, economics 101, hooray, it works. And so when you've got this strong lift in demand coming from the borders reopening, approximately a year ago, we had this influx of skilled migrants, and by definition, skilled migrants get a job and they earn money. Plus we get foreign students who are coming back to study here. Plus we're getting tourists, backpackers and the like. So we had this other scenario unfolding, hot demand, sort of only moderate increase in supply because construction has been held back by costs and availability of materials and the like. Hence, house prices were going to fall. That was my forecast. As you said, it was a 7% forecast from peak to trough, and here we are at -9. I think it's the most recent number from CoreLogic. And that was the basis of my view. And I'm still sticking with it.
I think that it's one of the things that's kind of missed with people is that we've had periods of time where rates have been rising and prices have been rising alongside with them. Because if you look at the peaks of the property cycle in 73, in 91, in 2008, you had a period of years where interest rates were rising and property prices were rising alongside it for all the reasons that you say. But obviously rates were rising at that point because there were improvements in the economy. Alongside, and so that's why you would expect to see property prices rise at that point. I think what people felt last year was that nobody quite expected this rate hiking cycle to be as sharp and as fast as it was. And you know, I can just say, like, working on the ground in the property market as I do, so I'm dealing with buyers and sellers all the time. It was never as bad on the ground as it was in 2018. In 2018, with that down drop, nobody wanted to buy anything. And there was just a lot of, there was no sense of urgency at all on the buyer side. The difference in this kind of point in the cycle is that there is actually energy for people who want to buy property. There's a lot of uncertainty in the economy. So whether it's for investment or whether it's just because of, you know, need and the population movements that we've had since COVID. So it never felt quite as bad on the ground, but this sharp rate hiking cycle, because it's taken us all unawares, and there was a lot of talk in late last year that, you know, are we reaching the point now where the RBA might go on pause? And I know that it's on your Twitter profile because you've got your forecast for what's happening this year, and I think one of the points there was that no more rate rises from the RBA, which was that
was my view. I thought there was enough information coming through, and dare I say it, in a couple of months into 2023, the data flows actually supported the fact that they arguably should have kept rates on hold in February, and they're probably going to hike again in March, of course. So you've got this sort of scenario where inflation has topped out. You know, the labour market's softening, growth is softening. You know, we've seen recent GDP figures, labour market figures, suggesting that maybe they don't need to do as much. And of course, the global economy's under some downward pressure from pretty draconian rate hikes in the US and New Zealand, and from the Bank of England, and even the European Central Bank hiking really aggressively too. So to me, it was sort of this scenario that maybe they don't need to, they need to just sit tight. But you know, when we saw in February, the RBA going to come out with obviously the rate hike, but also very hawkish rhetoric. The curious thing is that since then, the numbers have erred very, very clearly on the weak side.
Yeah, and the latest figures that have come out, because you know, I mean, like it's really got to the point now where it's getting damaging for the economy. I mean, the building approvals came out, and again, you made this call on Twitter. I'd advise anyone to follow your Twitter feed because it's very interesting, and you do these kind of 2-minute video quips on it where you give your opinion of sort of what's going on. But you know, came out with building approvals that are in free fall, the lowest in a decade, and that counts for non-residential approvals also, which are down by, I think, just over 25% over the month.
Correct.
You know, no growth per capita in GDP, you know, slight uptick in unemployment, those kind of indicators now. What, in your opinion, needs to happen right now? Are we at the point where we're saying that, you know, unless you do something, the economy's stuffed, basically?
Well, the economy is weak, yes, and the per capita stuff's very, very important because we mentioned demographics and population growth as a driver of housing demand, but it's also one where the new immigrants, they eat and they shop and they consume services and the like. So it's actually putting a bit of a floor under, you know, what might be called the headline GDP number. So if we know with a high degree of certainty that population growth is going to be 1.5% or thereabouts in annual terms. So if we've got GDP growth of 1.5%, which is actually what the RBA is forecasting for both 2023 and 2024, in per capita terms, it's broadly zero. So we're not going to be feeling any better in terms of our individual financial well-being. And it says to me too that the ability of firms to continually hike selling prices, which of course is only the way inflation can be sort of entrenched into a system, is not going to be there. And The other thing which I found really curious, just in the last few months, and it's been a thing that's been evolving more from the global markets, and that's one thing that I spend a lot of time looking at, outside Australia. Love Australia, and I'm an Australian economist, but what happens globally is very important. I look at the global commodity price cycle, and it's clearly softening. The oil price, for example, something that we notice every day when we fill up our car with petrol, in US dollar terms, it's roughly $80 a barrel. It was 120 at the peak. Lumber prices, timber goes into the construction side. It shot up by about threefold. It's back to actually lower than it was pre-pandemic. And then all the supply side issues, supply chain problems that have been, I won't say they've been resolved, but they've been largely resolved. And so you get this scenario that the things that caused inflation to spike in late 21 and through 2022 have not only stopped increasing, they've actually reversed to where they were. So with a bit of simple mathematics and a slower economy and the fact that policy is being tightened, you get to this scenario where inflation is going to be very weak. My fear is that the RBA do over-egg it, that they do deliver 1 or 2 or 3 rate hikes too many. But if they do that, the other bit that gives me a degree of comfort is that if they do that, they'll realise that and they'll have to reverse them, very late in 23 or through the course of 2024, where it's not impossible to see a scenario where there's rate cuts coming through.
Yeah, well, that was Westpac's big call, I think.
Bill Evans came out, yes, with he's got a few more hikes coming through, and I think he's got 7 rate cuts through 24, 25.
Yes. Between 2024 and 2025. I mean, it's a joke, really, when you think about it, isn't it, that we...
So why do it now? So why do you do these last couple? They're not needed. Just sit back and have a 6 or a 9 month interest rate pause. Yeah.
Yeah, I mean, it just seems crazy that we're on this seesaw and we're subject to, what the RBA are doing with, hiking up rates, which obviously isn't necessarily benefiting the economy. I don't even know that we can argue that it's slowing demand, obviously, but it's not had a marked impact on inflation because there's a lag of, as well that's coming through. So there's all of that to be generated. Now, obviously, Lowe was hauled up in front of Senate. Did you watch the debate?
Oh, yes, I watched it in the House of Reps appearance just a week or 2 back. Yes.
Yeah. I'm interested to know what you thought about that, because the quality of questions really, it was kind of generally poor. I think somebody asked him if he had any other tools that he could use to slow inflation. And then there was the political side of it that came out with, why are you destroying mortgage holders? Why are you causing rental prices to go upwards? Yeah. What was he going to say in that situation? That there, is it not?
Yeah, the political questions always bug me in those sorts of appearances that the RBA senior management and Dr. Lowe in particular appear at. That there's always one side or other trying to make a political point about you're the government and you've overstimulated the economy or something like that, regardless who's in power, and trying to get the interest rate hikes sort of sheeted home politically. Look, and that was disappointing. He did sort of outline, when he sort of drilled into some of the economics, on the issues that caused the error from 18 months ago, the no hikes till 2024 comment that he made. And of course, they were prefaced, and I've gone back and looked at the forecast from late 2021, and they were actually assuming, the Reserve Bank this is, that inflation would still be at or near the bottom of the target range through to 2024. That's why they said that we don't need to hike. And so this other thing that's occurring to me now, with arguably the RBA over-hiking at the moment, is that it's all based on their forecasts. So, for example, if I was forecasting over the next 12 to 18 months inflation to be still well above the target, of course I'd hike. If I was actually forecasting inflation in the next 12 to 18 months to be below the bottom of the target, I'd probably be, not only on hold, I'd probably be thinking about cutting rates. So the decision about whether to hike, hold steady, or ease interest rate policy is about the RBA's forecast. So the error in Lowe's comments in late 2021, no hikes till 2024, was based on his forecasts, or the RBA's forecasts. The possible error that they're making now is based on the fact that they think inflation is going to be very, very stubborn right through to 2025, because if they didn't have that inflation profile where it's still almost 5% at the end of this year, and still at 3% in the middle of 2025, they would pause. So it puts a huge amount of weight on this forecasting. And as we know, and I know as well as anybody, making these economic forecasts, particularly for something like inflation, is skittish, it's hazardous. And while we do our best, and so does the Reserve Bank, things come along to upset the apple cart quite often.
What I thought was interesting in what you put out yesterday, I think it was when you were talking about the building figures, was that you said get ready for house price boom to occur from it, because obviously we've got this massive influx of population happening, immigration happening, you know, the doors have been opened, the tap's been turned on, and we're in a worse position now in terms of, particularly in the rental market, rental accommodation, than we have ever been on record, you know, historical lows in vacancy rates. And I'm assuming that's what you're saying, get ready for the price.
And the boom, it's not going to be tomorrow or next month. It's more, again, housing cycles, in a sense, pinpointing the month or the quarter is not really that important, but it's more this sort of thing, because nobody buys a house for a 6-month investment, or not many people do, I don't think anyway. You buy it for multiple years. And I think what I was trying to say yesterday, and I think you captured it quite nicely, was that if we have that very sharp fall in building approvals, which is clearly underway, that we're going to be under building the number of new dwellings that we need. And of course, a building approval is just a blank piece of dirt at the moment, and it obviously takes a year or 18 months or even 2 years to turn into a completed dwelling for someone to live in. So the fact that we've got this building approvals momentum clearly falling very sharply says to me that if we were to sort of project based on the building approvals numbers, the number of new dwelling completions in 2024 and 2025, we're not going to have that many houses. And this is the other thing which I've got a lot more confidence about, because the government said it, we're going to have high levels of immigration over the next couple of years to address the labour market shortage and a bit of humanitarian increase in immigration and the like. So people will be here, and whether they rent or buy doesn't really faze me terribly much when I'm trying to work out the bigger picture stuff, because there'll be many more people here than there will be dwellings built to accommodate them. And as you correctly pointed out, that's already showing up in the rental market, because of course that's someone wanting to move into an established dwelling right now. And the rental market is incredibly tight. The vacancy rates are incredibly low, and rents, as we're hearing from the various people who monitor these things, are increasing at solid double-digit rates in most capital cities. That's, I think, the preemptive indicator of what will be happening to house prices. Gosh, in 9 or 12 months, to be sort of rocket fueled, if that's the right word, if in fact we find that the Reserve Bank has made an error, and as we were touching on a few moments ago, that they start easing rates in 2024, that will just add to this shortage of property, and demand for property equals a rise in prices of property.
Yeah. If they reduce rates at that time, coupled with all the factors that we're seeing now, I mean, it's going to be, well, I'd say, I was going to say like a disaster, but obviously you're looking absolutely at rocket fuel going under the property market, which would inevitably be followed at some point by another very sharp pullback, because over the last few years we've had such volatility anyway in the property market, haven't we? Because the 2008 downturn was alleviated obviously by stimulus going in with buyer grants. So when the rest of the world was tanking, their property private markets were tanking, we shot up like 25% into 2010. Then there was a pullback obviously into around mid 2012, and then like we shot up to 2017 before a very sharp pullback in 2018. And like I said, on the ground in 2018 it was a disaster. I mean, there was like no one wanted to buy, and the sellers gradually towards the end of 2018 thought that the market wasn't going to stop falling, and so there was a rush of stock that kind of went onto the market, obviously then followed by the COVID boom, then a dramatic pullback as we see this rate hiking cycle. I mean, if rates are then cut and we see and property prices take off again next year, say 24 into 25, 26, then that has to obviously inevitably be followed by
the next downturn. The cycle's perfect. And I think one of the interesting things that I've observed, you probably know more about this than me, is that all of a sudden, particularly with some of the volatility going on in the stock market, is that investors in the property market. It hasn't really shown up in the hard data on housing finance and investor versus owner-occupier activity. But with the property market in the major cities anyway, 10% cheaper than it was a year ago, broadly speaking. Rents going up at double-digit rates and vacancy rates being very, very low. For an investor, all of a sudden, even with interest rates having gone up, they could buy an investment property, and they tend to buy the less expensive properties, to the apartments and sort of little houses and these sorts of things to rent out. They'll rent it out very quickly. They'll get a fabulous rental return on it. And as I said, they bought it more cheaply than they would have a year ago. And so I'm wondering whether that's going to be one of the catalysts that puts a bit of a floor under house prices as well, just the simple rental dynamics that are going on right now.
I think one of the things that I've noticed with investors, there's a kind of trend that it's becoming so expensive to rent, particularly for parents that are dealing with trying to find student accommodation for kids, that they're getting to the point where they're saying, we might as well just buy. And
yes.
Particularly in the unit market, I've seen that kind of trend increasing. But do you know what? I have an issue with median prices anyway, particularly with the median price falls. It kind of disguises what's going on in the real market, because what we've seen over the, last year, the top end discounted very sharply. And, you might have said, well, the medium's fallen, 5% by that point. But the actual price drop that people have had to endure from the top end has been far more severe. Obviously they thought they were going to get, I've seen vendors that have had to discount their high-end properties by 500, 600,000, even more in some cases. So that was to get a sale into the sort of middle of the year. Things have improved a little bit now. The big discounting has happened. But if you shoot out to, I do a lot of buying for investors in regional locations because it's cheaper properties. You don't have to buy an apartment, which I don't consider a good investment. So you can buy a suburban house and a block of land in an area where there is some population growth because of what's happened with the work from home, the acceleration. And those prices, they haven't depreciated at all. I mean, you might say, well, the median's dropped in that area. But if you actually look at what properties were selling for, say, even just 12 months ago, some of them are selling for 100,000 more now than they were 12 months ago. So there's been an increase there. So, you hear the median, but it kind of gives you a woolly figure of what's really going on the ground. And like you said, Australia is a big place. In Perth and Adelaide, there's not been any fall in those markets. They've been
I was just going to say that, and that's a really interesting phenomenon. When I sort of occasionally take a step back and dig into the Australian market, I love Perth because it's such an interesting place, and it's a big city. We're not talking about some little regional town. It's 2 million people live in Perth, and obviously it's leveraged to the mining sector, both in terms of the people who service the mining sector and the like. But the fascinating thing for me, absolutely fascinating thing, was that during the period in the early 2000s, let's just say approximately, I don't know the numbers off the top of my head, but say from 2002 to 2010, which was 2008 anyway, which was a rate hiking cycle. Rate hiking, Perth prices went up 100% with the rate hikes. Then in the 2010s, as we had this very long rate cutting cycle from the Reserve Bank, right through from 2011 was the beginning of the rate cutting cycle to the COVID lockdowns, Perth prices fell in nominal terms. So Perth, which had the same negative gearing rules, it had the same, interest rate rules, all of those sorts of things, which some people suggest are important in driving house prices, somehow forced Perth to have a counter-cyclical issue. And when I sort of raise this, why did it happen? Everyone says, of course, it's the mining sector. And my answer is, yes, it was the mining investment boom, the mining investment pullback. And that says to me that while, okay, you can have differences in prices that are not necessarily linked to just interest rates, which again comes back to that very first question that you asked me about, why would house prices go up when we've had a rate hiking cycle in Australia? And it's because of supply and demand dynamics. It's other things that are at play. It's people have got a job and the labour market's strong. So it just says to me that there are very many differences from property prices, let alone the point that you made, the expensive ones versus let's call them more affordable dwellings. There's a very different picture at say, Balmoral in Sydney or in Penrith in Sydney.
Yeah, absolutely. And if you look back at Perth historically, I mean, its cycle really booms and busts on the mining.
Yes, it's a fantastic market to look at. Yes.
Yeah, I mean, even in the 1890s, I think when the East Coast was in the worst recession well, even worse than the 1930s recession, I think, Perth's property market was soaring because they were finding gold and whatever else there. So, yeah, I mean, it's an interesting history to study. And I think it's so important and so important for my subscribers who'll be watching this to understand that, that we're not looking, you cannot analyze a market through a one-eyed view of interest rates alone. But let's talk about that a little bit, because obviously the other thing that's hampering buyers, and this term has come out called mortgage prison, which I think is a cute term considering many people would think that mortgages are a prison, but people not being able to access the mortgage because of the serviceability buffer, which is 3%, obviously that is adding on to the fact that rates are going up. Then you've got the serviceability buffer, and then APRA, did this, well, we might reassess it. There was all this hoo-ha of, are they going to remove it or reduce it? Of course, they've come out and said, no, we're standing strong and we have a strong banking sector. What's your view on that? Do you think that it's a problem in the market?
There is a difficulty of people who might be able to, who wish to refinance. Just say they've got their 2-year term mortgage expiring about now. They're rolling over into an interest rate structure that's 3.5 percentage points higher than they had their loan. And if they're with the same financial institution, that mortgage prison, they're locked in, if you like. And with the stricter criteria now, as opposed to when they perhaps took out their mortgage a couple of years ago, their ability to quickly switch from lender XYZ to lender ABC, for example, is constrained by these regulatory requirements. So it actually compounds part of the problem. And I happen to think the Australian mortgage market is pretty competitive. If and people sort of say shop around, and yes. And other than having the slight inconvenience of doing a bit of paperwork to switch from one institution to another, in a worst case, you can save a small fortune. So the extent to which people are locked in and find it difficult to perhaps go to a competitor where there is a better, not only just interest rate, but there might be a longer term. We've had a discussion in the last few months about terms being extended from 30 years to 35 years. I think even in one case, 40 years, but anyway. And that, of course, reduces your month-to-month repayment. So I'm all for allowing some flexibility in the mortgage market. So I think APRA, with its sort of still being pretty strict, and look, I can understand why, but I think they've got to be a bit more realistic to think that, we're not going to get another 300 points of rate hikes. We might get in a worst case, 100, 125, maybe. Gosh, you'd need inflation to be very high. We aren't going to get another 300. That's one thing that I can be absolutely certain about.
I think, the other thing that's kind of come out with this is the number of people that fixed their rates, and this great big mortgage, fixed rate cliff that we're heading towards. And it's going to be a disaster, everyone's saying, because there's going to be this shock. You can't say that there's going to be a shock anymore. I mean, people have had a long time and to kind of come to terms with what's happening. And I know that every buyer that I deal with, every single one will come to me and they'll say, well, the bank will lend me this much, but I only want to spend this much because I'm expecting there to be more rate hikes. I'm scared about the future. I'm not sure what's going on. So the desire to buy hasn't gone. But what you don't see on the precipice of a downturn is people being careful with their money and being careful about what they spend. So do you think that there's going to be a problem with the rate cliff that's
yeah. Look, for those people who had one of these 2 and 3 year straight mortgages from 2 or 3 years ago, they should be drinking champagne, celebrating the fact that they've not been ratcheting up the interest rate cost curve like people with a variable mortgage. People with a variable mortgage have had the rate hikes in May, June, July, August, September, October, November, December. They've had to pay that higher monthly repayment pretty quickly after the rate hike's been delivered by the RBA. Whereas if you've been one of the lucky people, smart people, whatever the reason for getting this fixed rate mortgage, was you've been enjoying still paying these incredibly low interest rates. And now you're going to jump up to this higher mortgage interest rate, but you've had effectively the best part of a year where your repayments have been materially below those of others. And the thing about this mortgage cliff, I've been around economics a long time now, and most of the problems that we see in terms of economic hard landings and problems with the economy and, recessions or these sorts of things is when something completely unexpected comes along. The pandemic was an obvious one, or that we couldn't really foresee, for example, the subprime. Well, some people could see the subprime crisis in the US, but a lot of people didn't. It sort of came out of left field. The mortgage cliff is one issue that everybody knows about. The banks have been contacting people who have these particular mortgages and telling them with absolute certainty that your 2 and 3 year fixed rate mortgage ends on this particular date. And don't bury your head in the sand, because you will be paying a materially higher mortgage rate. So prepare for it now. And as I understand from the various commentary from the CEOs of CBA and NAB, they've been chatting in the media the last little while after their profit reports and the like. They're sort of been saying that, yes, they've been telling all their customers, and while customers are saying, damn it, that's a big increase in my monthly repayments, many of them will be able to cope reasonably well. They'll be swearing and cursing under their breath. They'll be adjusting their consumption patterns, as you touched on again. They'll be sort of trying to hunker down now, knowing that their repayments will be jumping by, $1,000 whatever dollars per month.
And the buyers that I deal with, I mean, that's exactly the reaction that I know of. I mean, some of them have had rental increases, so that's obviously assisted them. I mean, it was genius, wasn't it, to fix at that time? Because
it was a glorious thing. And to those who did it, good on you. I'm just jealous I didn't sort of take advantage of those rates.
And I admittedly the same. I mean, the consensus then was that rates weren't going to rise, and if anything, that they could even fall again. Which is kind of interesting, because if we do get the rate drop that Westpac and which is now being forecast, is there a possibility that we could go into a period of time where we have negative rates? We've seen it happen in other countries.
We have seen it in other countries, and they've all been taken away through this rate hiking cycle globally. Look, they were put in place because conditions were really poor, and we had basically disinflation, or in some instances deflation. Prices were falling. Now we're confronting a high inflation environment right now, and even our own Reserve Bank and a number of other central banks were reluctant to cut them to negative, but for a couple of different reasons. One, just sort of the logistics of banking prudential sort of regulations. There was a slight issue there. So look, I think it would take a very, very hard landing for the economy with genuine, broadly based deflation, that is, falling prices throughout the economy, for that to happen. So very unlikely, but in economics, I've learned never to say never, but very unlikely. We'd need a material change in the momentum of the economy and for inflation for that to happen.
Probably going to take after the next bust, after we've had the
possibly that might be 2027-8, but who knows. That's what we're all doing.
Yeah. Well timed with the research that I do, because that's exactly when I think that the next downturn will occur. You've obviously done a lot of work in politics. You've been around. I think you were economic advisor to Julia Gillard.
That's correct. Yes.
I'm interested. I'm president of Prosper Australia, which is actually Australia's oldest economics organisation, been around for a long time, because we follow the teachings or the advocacy of Henry George, who wanted to reduce incomes on labour and productivity and to put the tax base onto land and to monopoly rents. I'm interested in your opinion on that, what you kind of feel, because, we can have all this talk about, we need to get the budget back into surplus and all this economic management, but the taxes that we see really inflicted on the economy are really destructive taxes. And that was what the Henry Tax Review pointed out when it did its review, of course, in Rudd's time, was we completely need to move the tax base off income and productivity. What's your opinion
Yes, and the Henry Tax Review in summary, in a slightly different summary, was yes, tax consumption and land and tax incomes a little bit less. That's a massive summary of a very long research piece, and a really good piece of tax reform, if you like.
It went on the shelf.
I don't even know if we've taken even a couple of baby steps along that path, to be frank, that we've not really done anything, because the amount of revenue that the government raises from income taxes is high and growing, I believe, at the moment. The last budget numbers I saw confirm that. The capital gains, the goods and services tax, is raising a lesser proportion of the government's revenue, because a lot of things are excluded. So that's, and our spending patterns have changed over the 2 decades since it was introduced. So to me, that there's a whole lot of issues, and I'll take one further step back too. Working on the assumption, this is the political imperative, I think, that people do want the government to fund a decent level of education, healthcare. They want roads built. They want us to be defended. All of these sorts of things are an important part of what a government does. And that seems to be a bipartisan issue now. So we don't have too many advocates of small government, which is an interesting trend of the last 5 or 10 years. There are a few, but not many. And we know that the politics, even this recent debate that we're seeing about superannuation on taxes on people with more than $3 million in their super fund, shows how difficult it is to reform even relatively simple, straightforward reforms. It doesn't raise a huge amount of money, just by the way. So while my economics textbooks and the Henry Tax Review does have a strategy of really sound changes that could be implemented to the tax system, the political narrative now and the confrontational style of politics now means that any government, Labor, Liberal, whatever, will have one almighty difficult job of implementing them, even though they know in their heart of hearts that this is good economics. You'll enhance productivity if you can change your tax system, and so that's good for the economy, but the implementation is so easy to criticise that, oh, they're coming after you, they're going to tax you, they're going to put their hand in your pocket to tax you more than they would, and that's probably not true, because all they're trying to do is just reform the tax structure, make consumption taxes be a little bit higher, make income taxes being a little bit lower, which people don't generally see, and that's what makes the politics versus policy such a difficult thing for whoever is in power.
Yeah, and that's the thing with income taxes, isn't it? I mean, most people, unless you work for yourself, that is, and you're handing over big bills each month, most people don't see the income taxes that they pay, which makes land tax, unfortunately, one of the most hated taxes, despite being unequivocally a good tax in terms of the economic outcomes that it produces. And so the problem of this really is in transition, because I know one of the big complaints at the moment following the boom that we had through COVID is people aren't concentrating necessarily on the capital gains that they achieved over that time, which in most cases have not been wiped out by this downturn. Yeah. They're very acutely concentrated on how far property prices are going down now and what they should do, because so much of our economy is choreographed around the property industry. But equally, their land tax bills have just hiked up to such an extent that it's been enormous increases for people. And in an economy where you're taxing, you're hitting them with income taxes and productivity taxes, so you've got most of our taxes, of course, fall on labour income. It makes it very difficult to then transition and say, well, this is where we want to land the tax base, or this is where we feel that we should increase the base of taxes is on land, when you've got those problems. I mean, the transition is difficult. Did you ever have any conversations when you were in politics regarding that? I mean, was it a conversation that was kind of had in the back offices that never sort of reached our ears?
It was only in the back offices, never in the front offices, I can assure you that, chatting about, and even to this day, I have lots of cups of coffee in Parliament House with different people. I'm based in Canberra, by the way. And so the discussions there, and this is again a non-partisan, a non-partisan issue. Everybody knows what the right tax policy is, but then everybody sort of says, we cannot implement it because we will not win the next election. And that's the problem, that they know that the tax reforms that are needed on superannuation, on incomes, on company tax, on land taxes. We're seeing in New South Wales now that discussion about land taxes there versus paying stamp duty, these sorts of things, that they know what's the right decision, but it's very easy for the other side, whoever that is, to demonise it. And that makes the implementation really, really difficult, even though we economists and most other people at the end of the day realise that it's the right thing to do. There's enough people who will create that proverbial scare campaign to make sure that no one even puts it on the table. No one even sort of is prepared to sort of discuss it, let alone run to the next election trying to advocate this sort of a major tax overhaul.
Yeah, it's certainly been our experience that that we've seen that occur. Interesting that you're in Canberra. I actually didn't realise that. I was thinking for some reason that you were in Sydney, but you would obviously have witnessed the transition there.
I was just going to say, yes, we the ACT government, in its wisdom, oh gosh, I'd have to think now, about 7 or 8 years ago, if I remember correctly, implemented a scheme where the land tax via council rates was going to be increasing, stamp duty levels were going to be decreasing. So we've had quite a bit of experience of that right now. And I can assure you that the annual rates bill, land tax bill, when it comes in, is quite eye-watering for even modest properties, let alone expensive properties. But the stamp duty is lower. And the other thing that has occurred too is that it's been a massive discouragement for landlords and investors, because of course, if they're paying this supersized council rates, they've got to try to recoup that to make the investment viable, to make it sort of attractive. And of course, it's debatable whether you can do that. So Canberra sort of had this interesting experience where the vacancy rate for quite a while has been incredibly low, rents are very high, and this is with a pretty extensive construction boom along a lot of the infrastructure of railways. I won't get into all the Canberra details right now, but nonetheless, it's a real world example of how they're collecting lots of revenue. There's no doubt about that. The ACT government's financial position is actually reasonably strong, but the consequences for the rental market and the like are not so good, because it just means that investors are sort of, oh gee, if I'm going to be forking out a chunky amount of money in land tax every year, and I can't necessarily recoup that in my rents that I charge the tenants, I won't bother.
Yeah, I mean, well, that's obviously because we're an economy, really, when it comes to property investment, we are an economy that treats property not as a home, as an investment. I mean, I think everybody needs to understand that, and they do understand that. You can cry about it if you want, but unfortunately, that's the situation that we're in. But people are, and that, I think this is why the Canberra model, the leasehold model, one of the reasons why it initially broke down was because people that were holding land there were looking at what their neighbours in Melbourne and Sydney were recuperating in their capital gains, i.e. land price inflation that was occurring at the time, and thinking, well, I wish I could have some of that. I mean, when you look over in the States, where certainly in areas of the States where they have very high taxes on property, but lower income taxes, so take Texas, for example, you see the rents that are coming in, the yields on the properties are around 13-14% net, and we don't have that here. So for the model to work here, you can tinker around with it and you can do these changes, and obviously it's things that, well, we certainly advocate them at Prosper Australia, that the stamp duty to land tax is kind of low-hanging fruit, but to really change and have the benefits that should come from land taxation, which is lower land prices, because it is a discouragement to speculate on land, but also lower rents, because it's an encouragement to construct on land and to build more accommodation. To have those effects kind of wash through, I think you need everything else to click into place that we've discussed with the lower taxes on productivity. Is that kind of what you feel?
And I think you've alluded to one other thing which is evident in that sort of debate, is that income taxes are raised by the Commonwealth government and land taxes are inevitably linked to state and local governments, and they rarely see eye to eye. So what am I going to give up as the federal government, say, cutting income taxes to offset you, the state and territory governments, hiking your land tax. This is what makes it also more difficult. It's not just the politics of, you know, the opposition of the day opposing it because they can see political capital to be made. There's also this, you know, incredible impasse between the federal government and the state and territory governments who've got a very, very different agenda, I'm afraid. And that makes the reforms all the more difficult to get in as well.
Maybe it's time we brought back a federal land tax, which was because what we had, I think, in between 1911 and 1950 something.
Are we allowed to do? I'm not sure what the constitutionality of all that is, but well, yeah, maybe there's a case for that. Yes.
Yeah, it's not going to make you or me popular.
No, I doubt it either.
With the no land tax party that came out at one point. I always wish that we could have a no income tax party, but we've never quite achieved that in a political debate.
No, I don't think so.
Yeah, so and just kind of, I suppose, to round up, what's your advice to investors at this time? I mean, that's the question that everyone's wondering, you know, like, where the hell do we put our money, you know, in times like this where we're scared of sticking in the property market because we don't know what's going to happen to rates. You know, there's you, I think Louis Christopher, myself certainly have said, you know, house prices, if anything, under the current conditions, they're going to go up, but there's still a heap of uncertainty about that regarding what the RBA is going to do. What's going on? What's your advice to investors, you know, that come to you and say, well, you know?
Yeah, look, the kickoff point for me is that housing's always at least a 10-year investment, in my view. You don't buy a house and invest in property either as an owner-occupier, you know, you buy the best house you can afford, or as an investor, sort of to generate income and capital growth, with a view of 1 year, 2 years, 5 years even. It's too short. The cycles that we know for the property market in Australia is 10 years plus, 15 or 20 years ideally. Now, that says to me also that you will rarely be lucky enough, smart enough to pick the low point in any house price cycle. And in a sense, if the maths of your purchase adds up, I'm going to buy a property worth this much, I'm going to borrow that much, my rental return's going to be that much, and my income and the like, something else, do it. Go ahead and do it. But be wary of the fact that it is a long-term investment. In the first couple of years, yes, you might get more rate hikes. You know, I might be wrong. The RBA hikes 150 more basis points or something, and house prices do drop, as Christopher Joy is saying, up to 25% or something. You know, that's possible. That's possible. But if the maths of your investment decision still holds up in that sort of scenario, go ahead and do it, because the other thing that occurs from time to time is that when the Australian housing market takes off, it happens before you even know that it's happened. By that I mean, you'll be looking at the housing market, and then all of a sudden the housing data will come out, and there's a 5% jump in prices. And if you're looking at a place that's $1 million, that's $50,000 that's just materialised, or a gain that you haven't realised. So my general advice is, yes, don't buy something, and if in a year's time interest rates are up and the price has gone down 5%, don't cry. You know, don't worry too much about it, because come back to me in 10 years' time and let me know how that investment's going, and then we'll make an assessment of whether it was a good or a bad decision. And I think that's something that you've got to bear in mind, because there's still, as you alluded to, there still is a cycle. There's still a huge amount of uncertainty. You know, we're in this rare period of high inflation. We haven't had high inflation for 3 or 4 decades. So we're still negotiating our way through that. And I think the central banks are getting it under control. But if they're not, then it's a different equation. But for now, you know, look at that investment purchase, that owner-occupied purchase even, as something that will be cyclical. There'll be little bumps along the way in terms of interest rates and those sort of things. But in 10 years' time, even with very modest average annual increases in house prices, and even with very modest increases in your personal wealth and circumstances and your income, if you're a wage earner, you know, your financial position is going to look pretty rosy. And this is what a lot of the boomers did. And so that's where you get to see the generational conflict too. So if you're a young person now, do it. You know, just go out, you know, do your maths, make sure it all adds up, and make sure you put in a bit of a buffer. but buy a property now and look back in 10 years and then assess whether it's been the right decision. And it's almost always is. The only reason it is that you have some personal circumstance when you lose your job or something catastrophic happens. But if things are sort of normal, you'll never look back.
And you're right, it doesn't take much to lose that competitive advantage in the market. There's a big difference when it's just a negotiation between you and the vendor, which in this current market, it still could be in areas of Australia. I think Sydney has kind of tipped the corner, but and certainly Melbourne's, you know, looking a little bit hotter than it was last year. But as soon as you get 2 or 3 other people that are interested in a property, the price is gone. You know, you're then up against the vendor, so it can be the difference of tens of thousands of dollars. Thank you so much, Stephen, for coming on. I so appreciate it. Thank you for your
Thanks,
insight.
Catherine. I've enjoyed the conversation. We covered a lot of stuff. It was great fun.
Yeah, absolutely. Been really fascinating to chat to you, and I'd love to have you back on in the future when we get a few months down the line, see how the economy is going, and
see how these predictions are going, seeing whether we've actually found the base in house prices, which I still think we will sometime between now and the middle of 2023. The base is sort of forming.
Yeah, I absolutely agree with you. Absolutely agree. Thanks so much. Thanks.